Thank you. Let me start with the bottom line of my presentation, my main thesis, which is that the banking sector will be and has to be a key driver of a better outlook, a faster recovery of the region. But the banking sector cannot be the force that will jumpstart the recovery. So it's a necessary condition, is not sufficient. Now, my remarks will focus on the Eurozone Mediterranean, the Eurozone periphery, which is where my expertise are. And one can argue this thesis with a positive story, and one can also argue the thesis with a negative story. Now, the truth most likely is somewhere in the middle. Let me start with a positive story. There is no doubt that the banks in the region are in a much better shape today compared to a few years ago during the unsustainable boom years that led to the crisis. The banks have cleaned up their portfolios, and they're still cleaning them up. So their portfolio is healthier. They are much more prudent in their lending, much more cautious. So their lending is much healthier. They have gone through a number of stress tests, and they are today much better capitalized. Now, you remember when the ECB started the stress tests, these were criticized as not being tough enough, as being a kick of the can down the road. I haven't heard such criticism for a long time now, especially the last one was considered a credible test. Supervision has improved tremendously, both in the countries themselves, but also now the ECB is on the driver's seat. And from this point of view, coordination across country of supervision is way much better. Monetary policy is very supportive. The ECB is doing whatever it can be done. And the main goal of the ECB policies is to support credit growth. So the main strategy of the ECB is through the banking sector. And in a way, this is inevitable because the presence of the banking sector in the financial markets in Eurozone is extremely important, much more important than in the US, where capital markets are more developed, and even more so in the Mediterranean, where the vast share of enterprises are small and medium enterprises, so they rely on their banks for the lending. Countries themselves have been addressing their problems. A lot of reforms have been implemented after the crisis. These economies are healthier. And although the recovery has been slow, we can argue that this is a healthier kind of growth. After all, the fast growth that we saw in the boom years led to the imbalances and the crisis that we saw afterwards. So sometimes slow growth can be better growth if it is a growth that can be sustained. So that's a positive story, but even this story suggests that you have a banking sector that is cautious, which also suggests that the banking sector will wait for a faster recovery to start contributing to this recovery. It's a bit a chicken and egg problem, but you are not going to have a banking sector that in a weak recovery starts expanding credit, and then this leads to a faster recovery. So it goes back to my thesis that the banking sector will be a key driver of the recovery, but cannot jumpstart the recovery. Now, let me tell more or less the same story, but in a negative way. The banks in the region still have a high stock of non-performing loans. Some cases in some countries, very, very high. And even if they are doing everything right, it will take many years to reduce it. The recovery has been very, very slow. So as a result, banks have to take this into account in their plans. This affects their profitability. They are operating in countries that still have very high debt levels. Now, we seem to forget that. The ECB, through its QE program, has compressed sovereign spreads throughout the region. But this suggests that sovereign yields do not fully reflect, if at all, sovereign risks. But this is not a sustainable situation. If the ECB reaches the inflation target, QE will stop, so yields will have to increase. They will start reflecting sovereign risks. So at that stage, debt dynamics will become much more challenging. If the ECB misses the inflation target, if you do a simple debt sustainability analysis and instead of 2% inflation target, you plug 1%, again, you get very challenging debt dynamics. Monetary policy has been supportive, but also there is not so much coordination with supervision. In a way, the right hand and the left hand of the ECB are not coordinating. Monetary policy is giving incentives to banks to extend credit, but the ECB as a supervisor is putting limits on the extent to which banks can extend credit. It's not only a supply issue, it's also a demand issue. Many banks in the region, and rightly so, they are complaining that they don't have demand for credit, and actually the demand that they have is not necessarily good demand. As I said earlier, banks are more cautious in their lending. And we don't really have a banking union in the Eurozone. Friends of mine at work who are from Spain, they can borrow at very low fixed interest rates to buy a house. I cannot get a mortgage in my own country, Greece, despite having an income from abroad. And any other Eurozone bank will not give me a loan to borrow from Greece. That's not a banking union. And the deposits in all the countries in the region depend on the sovereign, which is also puts the whole sector at risk. So let me go back to my thesis. As I said, the truth is somewhere in the middle. The banking sector has to be a key element of the recovery. It cannot jumpstart it, but nothing can jumpstart the recovery. We need all the right policies to operate together. We need what the ECB is doing. We need better coordination of fiscal policies. We need structural reforms. And then, hopefully, this will create a positive feedback loop with the banking sector having a key role towards a faster recovery. Let me stop here. Thank you.